So welcome everyone to a financial preparation common pitfall webinar. So this webinar is just more to educate people so that people are more informed about general around financial statement preparation, right? We're not preparing the financial statements in this webinar. We're not going to open Excel files and work through a financial statement. We're just going to have panelists talk about their own experience as regards the topic and the common pitfalls. Yeah. So I hope that's clear. Now, let's go next page. It's behaving. No, sorry, hold on. And this thing. Right. At the moment, we've tried to put everybody on mute, and the idea is to basically ensure that the user experience in terms of the webinar is very rich, right? We generally encourage people to contribute, right? And you can contribute better by unmuting yourself or sending a message to a chat box. But generally, as the session progresses, we encourage people to make use of the chat box, right? The only instance where we unmute you is when we want to engage or interact with you, and there are specific sessions that have been marked towards questions where you get to ask questions from your own perspective and the panelists will respond. Now, it's a learning environment, so no question will be taken for granted. So whatever questions you have, please make use of the chat box in terms of asking questions. Yeah, we are more than happy to answer such questions. Yeah. Now, for just joining us for the first time, right? This webinar is being hosted by Accounting Yard. Basically, we've been set up to basically improve practical accounting knowledge or experience of accountants. So when we established Accounting Yard, we identified that people generally do not have practical experience to help them in their day-to-day work, right? We have ICANN and ACCA, which basically caters for in terms of theoretical knowledge, but what exactly happens in terms of our day-to-day work as accountants. So based on that, we set up Accounting Yard, whereby we basically share knowledge on various social media platforms. We organize webinars such as this, and we also organize trainings that cover various areas, right? So we've created training around preparation of manual accounts, we're training around financial modeling and budgets. We created training around the accounting circle. We created training on Excel for accountants. We created training on audit, on tax, and various areas, right? And basically that way we're able to ensure we enrich accountants in terms of practical knowledge in accounting. Now, we don't leave you there, right? We believe that after we've basically been able to share in terms of knowledge and information, right, being able to share vacancies to help you in terms of getting your next job, also in terms of helping you potentially review CVs just to help you improve the process of getting a new job, or even helps in terms of organizing webinars where we talk about how to interview for accounting related roles, right? So we are kind of end to end in terms of how we enrich accountants. We don't just share knowledge, we share vacancies. We don't just share vacancies, we help in terms of preparation for interviews and the likes. Now, we have an upcoming training on 5th of October on financial statement preparation. And if it's something that you feel interested, do free to reach out to us to the official number. Now, who am I? My name is Oladile. I'm an accountant like you, right? I'm a teacher. I'm also a YouTuber in terms of content I create on YouTube channel as part of the content we create on for Accounting Yard. I have over a decade experience in terms of financial accounting and audit, right? My current role is kind of head of finance within one of the largest agri-tech business in Nigeria. I'm also involved in terms of plan analysis. For people that know me, they call me Mr. Right, some people call me Prof. But I am your host today. I'll basically be the one managing end-to-end of the webinar while we have panelists on this particular webinar. Now, generally, in terms of how the webinar will flow, it's always good to have an expectation, right? And that expectation is basically from you, our audience, right? Participants who have joined this webinar. So it'd be nice to understand from your own perspective, what exactly is your expectation? So when you saw the webinar, what were the things that came to mind and you wanted to learn? So now, from this perspective, it will be nice to you to share in form of chat, in chat box, and in cases where you want to actually talk, right, you can easily just signify by raise of your hands, and I'll mute you to be able to express yourself. Yeah. So feel free to ask questions in the chat box, and we'll definitely read and try to read out the kind of comments that are coming through there. Does anyone? Let me try and see. Mm, And for those who have their videos on, I suggest you generally turn off your video because this content is going to be shared on YouTube channel. So you don't want to see your face in public platforms, right? Hmm, let me see. And what you Hold on, I'm trying to get. Yep. Great. Mm, sorry. Yeah. Okay. Hi, Jerry. So just confirm you can hear me. No,
Hi, can you hear me?
yes, sure, I can hear you.
Okay, great.
Yeah. So if you don't mind, you can help us just read the comments from people in terms of people sharing their expectation.
Okay, that's great. I think before I do that, I just want to do a quick introduction
Yeah. Sorry
as
about
well, so people aren't wondering
that.
um, who the strange face is. Hi, everyone. My name is Jiri. I'm a senior audit manager with an audit consulting firm. I started my career a long time ago as well. Around the same time Dele did as well. But unlike him, I haven't worked in industry at all. So all of my experience has been in consulting, just helping clients kind of figure out how to prepare their financial statements, perform a thorough audit, and make sure that the financial information that they're putting out there is compliant with the regulatory and IFRS requirements. So happy to be on this call with you all. And I think one thing that I did see in the comments was that a lot of people are looking to learn how to prepare their financial statements without error and also learn from professionals about common errors in FS preparation. So I think that's a great perspective to have to this. I think that's something that Accounting Yard has been doing very well. over the last few years, just getting people to get that practical experience and step away from what you would consider to be just theory, right? So I think that's a great way to come. That's a great perspective to bring to this, and I'm hoping everyone on the call goes away with at least one or two new pointers and a general sense of direction on how to prepare financial statements that are error-free and compliant with both the legal and regulatory requirements. Okay. Is there anyone else? I see a lot of the comments are talking about preparing using the IAS and IFRS standard. Okay. Someone's also looking to learn how to prepare using accounting software. Um, is there anyone, I don't know if you want to give more perspective on that. When you say accounting software, are there any specifics that you have in mind? And maybe that's something we might look to talk about on this session as well.
Mhm. So yeah, just to add to what Jira said, so it's a webinar, right? Trust me, 2 hours may not be sufficient to do a lot of things that relate to financial statement preparation. The idea is to provide the right insights to open your mind to the potential or what it entails, such that you would now know, oh, how important the skill is and how you need to take it to the next step and things you need to pay attention to, right, during the preparation of financial statements. Um, from my own personal experience, I know it's a very vital skill, right? And I'm sure during the course of the webinar, as we go further, you would see us bringing conversations around it, right? Because the reality is that a lot of people don't know how to prepare it, right? You find out that most times your financial statement is prepared by maybe your auditor, right? Or is given to a consultant. And that's because people don't know how to prepare it, right? A lot of people are more familiar with operation of manual accounts, which we also talk about. And yeah, there are softwares that can help you in preparation of financial statements. We'll talk about that also from another context. Yeah.
Okay. I
Okay.
think one thing that you touched on now was just, saying how sometimes the client will just give the FS to the auditor to prepare, which more often than not, especially if it's a public entity, is not something that should be happening, right? And so, again, just asking to make this as interactive as possible. If you think there are specific questions, or maybe when we look at the questions that are coming through the chat, and we're just trying to get some insight on that, please feel free to unmute yourself and ask those questions directly.
All right.
Okay, do.
All right, so I think we've gathered a lot of information relating to questions in terms of perspective, the expectations for webinar. Basically, we have two panelists. One panelist has introduced himself, which is Jiri Adekola. The second panelist is Ifeanyi Odeze, also a professional colleague. And Ifeanyi, if you don't mind, you can unmute yourself and just basically introduce yourself.
Hi, can you hear me?
Yes, we can hear you fine.
Okay, great. Hi everybody. Good to be on the call with you. And hi, Jure, it's been a while. So good to see you as well. My name is Ifeanyi. I also work in a consulting firm as well, and I started my career in the banking industry and then got into accounting consulting, and that's what I've done for the last 10 years. Um, my role is basically to advise on transactions, financial reporting issues. That's what my current role basically entails. And so I'm happy to share my experience with everyone and share the common pitfalls that I see. I saw somebody wrote, "Oh, I'm an auditor and I want to know how to review financial statements." I do that quite a lot. And there are some common errors in there. So I'm happy to share insights about that with you. Thanks, Dilly.
All right. So thanks, Ifeanyi. Thanks for a rod. I know that this came last minute, and I really appreciate the fact that you to make out time out of your busy schedule to join this call. And same with Jiri, and really appreciate you. So basically, we'll get into the actual session where we'll start just talking through questions during the course of the webinar. So I've heard that the video is kind of dragging the bandwidth of the connection. So we may just go off video just to improve the bandwidth. And just in one or two places, we can just turn on the video just so that people can know the faces behind the people talking, right? So yeah, so I'll also go off video. Yeah, all right. Great. Yeah, so I think the first thing that comes to mind is the introduction to financial manipulation, right? So to the man on the street, what's the financial statement and how is it different from manual account? I don't know, Jerry, if do you want to start?
Yeah, sure. Happy to start on that. I think one way to look at management accounts is it's what you make of it, right? It's internal, so it's very specific to that business, and it's been prepared by, the accountant. It could be a financial accountant or a management accountant or a cost accountant, anyone really in the business, and it's specific because you just want to show um just the financial performance of maybe one division or financial performance over the last month or over the last quarter, or just how a specific SKU or item that's being sold by the company or a service that they're providing, how that's performing financially, right? And so it's typically not as detailed. There aren't any specific regulations. It is what you make of it. And um, the only real oversight there is going to be coming from whoever will be reviewing that financial statement, that management account. On the other hand, I think your financial statement, is a lot more specific in terms of the required structure. There are a number of regulations. I think I saw a lot of people touched on those, your IAS and IFRS, and, depending on what part of the world or wherever your investors are, you might need to also prepare them in like other regulatory frameworks like your US GAAP or UK GAAP or like the PCOB standards, right? And so all of those things add to the rigor that's expected to be put into preparing your financial statement. But if you're talking to the man on the streets, your financial statement is really just a way that a company explains their financial performance over the last few months, over the last quarter, over the last year, in line with a specific set of accounting standards and a specific legal framework. That's, I think, is the major difference between the financial statement and management accounts.
Okay. If I do you want to add any salt or pepper to what I said?
So I think Jerry already did a good job. The management accounts are, more dynamic in the sense that really you tailor it to whatever you need. And a lot of the times, the business or the accountant or whoever prepares it, the purpose for preparing it helps you to improve efficiency as it goes. So you're not preparing management accounts maybe once a year. It's something that is ongoing because you want to use that information in making decisions, business decisions, and all whatnot. And that's why your management accounts could be based on a department or anything at all. And just like Jury said, the reverse is the case for the financial statements because that shows, the position of the business as a whole, right? The position of the business, what the business has done as a whole, during the year and, the liquidity of the business during the year. So that's basically the difference. And I think another key thing to know about the financial statements, a lot of times the focus is on, how external people perceive you as an entity. So you're reporting back to shareholders, investors might want to look into your financial statements, creditors might want to look into your financial statements. So you're reporting your business to the outside world, basically. But the management account is more internal to say, okay, what business decisions are we going to, take in the future based on how our business is performing from month to month, quarterly, whatever time period you choose as a business.
All right. Thanks a lot, Ifeanyi, and thanks, Jerry. So I think you've both spoken well. So still on introduction to financial statement. So I know one critical thing, right, in terms of preparation is a lot of people, if they are thrown into the ocean, right, I say, oh, prepare a financial statement. From your own perspective, if you want to guide someone in terms of step-by-step basis on how the person should go about preparation of financial statements, what would that be for you, right? If I don't mind, I don't mind starting from you, just to provide more context from your own perspective.
Okay, so from my perspective, if I'm told to prepare the financial statement, the first question I want to ask is, what framework or what set of guidelines am I using to prepare these financial statements? I think Jure had mentioned initially, it could be IFRS, it could be some GAAP depending on where you are, for example, the UK GAAP or whatever country you are in. There might be, different frameworks for different kinds of entities, right? So the first question you want to ask yourself is, prepare financial statements in line with what accounting framework? Now, that accounting framework would, give guidelines on how to, measure, certain kinds of assets, transactions, basically a list of guidelines to use to prepare your financial statements. The next thing that you want to think about is the data that you use to meet those requirements of the accounting framework, right? Where do I get this data from? How do I keep this data? Do I use an accounting software? Am I using Excel? How do I trace this data? Because basically your data is what you use to prepare the financial statements and is garbage in, garbage out. So if your data is not accurate, reliable, your financial statements will mirror that. It wouldn't be reliable and it will be useless, right? So the second thing I'll be thinking about is, my data, how do I post this? What am I using? Is it better to use, do some automation to remove some errors? So I will think about my data. And then I will also think about the trial balance at the end of the day. And this is on the back of, your transactions and your daily postings and the data that you use. At the end of the day, I want to come up with a trial balance with I would say a trial balance with enough granularity to meet the requirements of the accounting framework that is governing your financial statements. So I would also think about the trial balance, and then in line with this also the accounting framework will tell you the kind of disclosures to have in your financial statements, right? So you then want to think about, now I have this trial balance. How do I meet the requirements of this standard, right? And that drives what I disclose in my financial statements, what line items I would have on, for example, my balance sheet or the income statement, because the accounting framework will tell you exactly at the minimum what should be on each of these statements. And then that drives, what I present, where I present, what I present, right? And what generally makes up the financial statements as a whole. So I will leave it there for, Jiri to take it from there.
Okay, I see Femi
No, but
John
don't worry.
has a question.
So questions, there's a section for questions, right? Just go
Okay.
ahead. I would suggest, Femi, just take note of your question. There are places where people can ask questions. There are what's called midpoints where we actually have dedicated for people to ask questions. So Jerry, just please go ahead.
Okay. Well, let me please put your question in the chat box so we don't lose track of it, and then we can look at that later. But I think Ifeanyi has touched on most of the key things that you need to look at. But one, I do want to draw a connection between your management accounts and your financial statements. She talked a lot about data and the granularity of the information. How much information do you want to disclose in your financial statement is really driven by the requirements of the IFRS, right? Um, and so a lot of that information is going to be coming from your general ledger that has the actual transactions and balances, but some of that has also been prepared in your management accounts. So it's not something that you say, oh, because it's internal and it's only for the use of the chief accountant or the use of the CFO, it has no use in your financial statements preparation. I do find in my experience that when I'm trying to get details about disclosures, a lot of the time that information is in the management account, and it's more about bringing it all together in a way that is compliant with the IFRS. And just on that, I think one other thing that I know, and again, it's just more from my perspective, kind of from speaking with regulators and seeing what they concern themselves with, is just the level of disclosures that you want to make in your financial statements. The IFRS is principle based, but it does give you minimum level of disclosures that are required. And so you need to kind of look at, for each balance that you're presenting in the financial statement, what does the IFRS standard say about the expected level of disclosures, the minimum level of disclosures, and are you able to get to that? So your IFRS and IAS, they're all part of your International Financial Reporting Standards, which is what Nigeria has adopted, and that makes up part of that's part of our gap. So I'm just responding to Yanulua's question as well, because it does relate to this. So our gap is your generally accepted accounting principles, if I remember that correctly. And so it's just a body of accounting standards that you use basically to prepare your financial statement. So I think in putting that all together, just think about your disclosures, think about your source of data. Is it accurate? Is it correct? Right? Is it complete as well? And for a mid-sized company, you're also looking at, what are my investors and stakeholders looking out for here, right? The level of disclosure that might be needed for, say, a big multinational might not be required for a mid-sized company. So it's just gauging, the expectations of your shareholders, and that might come through conversations with your reporting supervisor or anyone else who's interacting with them, and that'll provide you more guidance on what you'll be looking to put together in your financial statements.
All right. Thanks, Jerry. So I think in a way we've kind of addressed this, but I'll just still allow you to give specifics. So what kind of critical documents and information are required at the outset of the financial statement preparation process, right? So just quick bullet points.
Yeah, trial balance. That's
Yeah.
the biggest,
Mhm.
right? It has your account, your GL. So you need your trial balance.
Mhm.
You need your accounting standards, your IFRS,
Mhm.
right? You need your management accounts as well. And you need your supporting schedules, right? So if you're looking at legal information that maybe the CAMA, your company's allied matters act, needs you to disclose, that might be something you need from your legal team. Personal information might be something you need from your HR team. So this is not something that sits only within the accounting and finance department of your company, right? So you need to reach out to them um, ahead of time and let them understand, hey, I'm going to be needing, maybe a breakdown of the number of employees we have and general ballpark figures for what their gross expense is, right? So I think when you have that, you have your underlying schedules, you have your TB or trial balance, and you have your accounting standards, and then of course, depending on how you want to prepare it, are you using an accounting software to
Mhm.
prepare the FS, or would you be doing this on Microsoft Excel, or would you be using Microsoft Word, right? You need to make sure that you have the right tool to prepare the financial statements as well.
All right, thanks, Jerry. Ifeanyi, do you want to add any more context to that?
I think Jerry covered that pretty well.
Okay. Yeah. So just to add a little bit of coloring to that, right? So in terms of schedules where Geo was trying to provide context into that. So common examples are like your fixed asset movement schedule, where you're basically showing the various classes of assets, movement in terms of costs, perspective, and in terms of your accrued debt, right? You could have disclosure around your movement in borrowings, how much borrowings did you open with? What are the new borrowings you drew down? How did you repay in the period? How much interest did you accrue? So those are things that schedules that you may require, right? Depending on the kind of information on your financial statement, right? So from perspective of management account, typically a management account, because you prepared over time, in terms of your mapping of your trial balance, it can provide the right context into how you map the trial balance for your financial statement. So that will give you a lot of context, right? Some businesses like to reconcile their financial statement to the management account to see how does it differ and why are there differences, right? Because of certain requirements in terms of disclosure that are being met, right? So you also see that play some perspective. Yeah. Yeah, just me adding some color in there. So understand and implementing accounting standards, right? How do recent changes in accounting standards impact the creation of financial statements? Um, if you don't mind.
Okay. So like I said before, these standards prescribe, you know, how you should, value or measure, different transactions. And then it would tell you the different options you have. It will tell you the disclosures that are required, and all of that, right? And this because, things change, there are a lot of advancements, there are a lot of researches. The IFRSs are also very dynamic, so new things are going to come out, and the overlay or the big picture is how do we report what has happened in this business in a more transparent and value-adding manner to shareholders and all stakeholders, right? So you find out that from time to time, the IASB, for example, which is the body in charge of setting the IFRSs, they would come up with, a new standard that tells you how to account for a particular kind of transaction in a better way, maybe because it provides more transparency. Now, when those things happen, they have a direct impact on your financial statements if you have transactions, in that particular area. So, for example, there is a standard that has been released this year and it's called IFRS 18, which is on presentation of financial statements, right? For everyone that prepares financial statements in line with IFRS, this standard will affect that business. And what that standard is aims to do is to, rearrange how transactions are reported so that it's more beneficial for stakeholders. So that standard will basically change a lot of things. It's going to bring a lot of insight. And for you as the preparer of a financial statement, you need to be aware of those developments in the financial reporting space, right? Because the standard will tell you when it is also effective. And I think for IFRS 18 is effective in 2027. But because it's a big change, you need to already start thinking of how to comply with that standard when it becomes effective, right? So these changes, what you need to think about as a business when you hear of these changes or changes that are coming is, do I have transactions that will be impacted by this change? Or are there disclosures that will be impacted by this change? What is the impact on this change on my books today and our prospects in the future? You might not be doing a transaction today, but you intend to get into a particular transaction the next year. And this standard is going to be effective in 2 years. So as at today, you need to be thinking already, what changes am I going to make to my financial statements to be able to comply? And sometimes these changes may involve a change to your software. If you're using a software, right? It may be a change that would make you move from doing things manually to automating that process, right? So those are the kind of things that you think about when there's a change that is coming. How do I get my financials to comply? What's the impact on my operations to be able to comply with what the standard is saying or what is coming in the future? So you're thinking about the impact on your operations. You're thinking about the impact possibly on your capex, because you might just be spending more to buy a software that could help you meet those requirements. So the impact could be far-reaching, but because we're talking about financial statements, I would just limit it to the financial statements itself. There might be new disclosures involved. There might be presentation changes that you might have to, consider in your financial statements as well. There might be valuation changes that you might have to consider in your financial statements as well. I'll put a pause there and allow Jure to add anything.
I think it's really important. Like you touched on a lot of key points, but one thing that I do find to be helpful is, and like you said, you have your IFRS 18 that's coming. That's going to change a lot of things. You need as a preparer of financial statements to understand your business, right? What does your company do? What industries do they play in? What legal, regulatory, and accounting standards might apply to them, right? And are there things that now need to be disclosed just because of the the company's operations, right? And like if I said, a lot of that might require you needing to pull data um, from different sources. So you need to think about that as well. One big thing outside of IFRS 18 is like ESG disclosures that need to come through. Granted, that would typically apply to bigger companies, but if your company is, one that plays in environment sustainability space, right? There might be required mandatory disclosures that you need to make that you may not have had to do previously. So that's something that you need to think about as well, and also consider how do you bring this together, right? And make sure that you're disclosing the right information. One thing I typically do is I just go online and do a quick Google search, right? What are the new accounting standards that are applicable? I think each of the major consulting firms, they all have those publications that they release periodically. Some even have dedicated websites for that. So you can just do a Google search, new IFRS standards in 2024, and that'll give you a whole raft of resources that you can look at. And so you can start putting together the data and information that you need early enough, right? Because the key thing is your financial statement is just you're showing to the public how your company has performed. And to do that, you need to make sure that you're disclosing the right information. So if you miss a key disclosure, then your financial statements really would not be compliant.
Thanks, Jiri. So yeah, thanks a lot for that. So I think, yeah, so we've gotten to a space where we'd basically allow participants to ask questions. So we can take room to like maybe 3 or 4 questions. And basically Jiri or Ifeanyi, whoever feels comfortable can answer the question in that context. So people can raise up their hands or can just take questions from the chat box. So, Jay, you can help with the chat box questions, yeah?
Yeah, I could take that. Yep. Yes, there is another standard on ESG reporting that's separate from IFRS 18 as well. I don't know if Nigeria's adopted that yet. Different jurisdictions around the world are pacing themselves. I think right now the EU, the European Union, is probably further ahead than anyone else in adopting ESG and making that mandatory for companies, especially listed companies. So if, your medium size company is listed and they have operations in the EU, then definitely that's something you need to think about. IFRS 18 on the other hand, and I mean, I think you have more expertise on this than I do, but if I remember correctly, IFRS 18 is more about the presentation of the financial statements. And so that's just coming to replace your IAS 1 and kind of change the the way you present things, right? Um, in terms of data, well, data just depends on what's the information that you're looking to pass across, right? So if it's ESG, you need to get that from your operations and technical people, right? What areas do they operate in, right? If you're looking at maybe you need to disclose director information, that's something that you need to get from your legal team or the company secretary, right? To make sure they're disclosing the right information. So I think the data that you would need is dependent on the information that you're looking to disclose in your financial statements. There's no one set of data in that sense. And I think there's a question from Peter here on management reporting. As far as I know, no, I don't think there's a specific standard for management account. I think one of the initial talking points when we started this session was that it's what you make of it. So it's just dependent on whatever your reporting supervisor or whoever has asked for those management accounts to be prepared. That's what will determine the information that goes into your management account compared to what goes into the financial statements that's driven by the gap that's applicable in that jurisdiction. Okay, I think those are all of the questions right now.
All right, that's fine. So no one has his hands up. So I think we can move on to the next phase of things.
Yeah, and for some of the other questions, I'll just respond in the chats directly as well.
That's fine. So now we're into the section within common pitfall and challenges. So this question will be directed to you. So what are the most common mistakes made during the financial statement preparation process, and how can they be avoided?
So this is the process, right? Not the financial statements itself.
You will do both, right? The process and also the financial statement itself.
Okay, so first of all, for the financial statement process, I think a lot of times, if we start from the beginning, it's maybe wrong postings or maybe right. I find out from my experience a lot of times is that what I found out is that sometimes the person that is preparing these financial statements may not have adequate knowledge or the adequate skills to, go ahead with that process. So you find a lot of basic errors just because this person doesn't know this, right? So I will put a lot of emphasis on upskilling in terms of what the financial statements are, what are they expected to show, what if I'm using IFRS, what does IFRS require, what do I have an idea of what the end product is supposed to look like. And I mean, if you don't know that, maybe you should get, adequate coaching to help you do that, right? Then also there's also the issue of, just human error, right? Posting to the wrong ledger accounts. Okay. So you should have debited um a maybe some property, you debited some intangible assets, and so your financial statement is showing that your property is understated and the intangible assets is overstated. So just human errors around, posting to the wrong accounts, and all of that. And then the other part where I see a problem is around consistency in the financial statements, right? In some companies, maybe bigger companies, different parts of the accounts are prepared by different people. So sometimes by the time they piece all of the information together, there's a bit of, inconsistencies around, in different areas in one single report. The other thing that I've seen with financial statements is in terms of the granularity. So when I say granularity, I mean comparing what the standards expect you to disclose and what your ledger balances or what information your trial balances allow you to disclose. And that means that every time you need to prepare financial statements, you need to do some manual reconciliation to be able to comply with the standards. And as you know, once there's a lot of manual information, there's a lot of errors that also come into play. So you might also see some, inconsistencies around that. So in terms of the financial statements themselves, you may also see things like disclosures in the financials not meeting the requirements of the standard. That's one that is very, very common. So you see missing disclosures here and there, especially when those disclosures are material to a particular business. So you actually have a lot to disclose in this regard, but it's just missing from the financial statements. I think I already mentioned inconsistencies in the financial statements. You talk about one information in this area, but it does not agree with the information that you've provided in another area. So there's also that inconsistency with information in one financial report. What other common? I think there are also mistakes in terms of applying the standard, right? One key thing to note is that sometimes the standard will give options on how to treat a particular transaction, right? And an entity needs to determine what way we are treating it, which we call the accounting policies of a company. So you determine how you're going to treat this transaction in your own books. And we found out that there's inconsistency in the accounting policies of a company and what the company has actually done in that financial statement. So that's another common area where we see pitfalls in the financial statements. I will just hold off there and allow any additions.
All right, thanks, fine. Jerry, do you want to add any coloring or anything to this?
Uh, Not exactly. I think just talking on the disclosures, in terms of, knowing what needs to go into your financial statements. Again, the big four, your mid-sized, next 10, however you want to call it, a lot of these firms have disclosure checklists on their websites, right? Again, that's what I use as well from a practical perspective. Just go on the website and check IFRS for SMEs disclosure checklist if your company is mid-sized or it's an SME, or IFRS disclosure checklist for 2024, right? And so you can download that. To Ifane's point, it shows you, what are the different options for what needs to be disclosed in your financial statements. And then you can compare to your draft financial statements to see that you're actually in line with what is required by the standard. And so whichever disclosures have not been identified or have not been properly disclosed in your FS, you can then update to capture that. And I think that that also kind of responds to, I know a few people earlier in the session kind of talked about being able to review financial statements properly, either as accountants or as auditors. That's one of the tools that I use. Just going through that checklist is very step by step. Just talks about have you disclosed your revenue, your cost of sales, net profit, all the key things that need to show on the face of the FS and in the notes, and that you're just putting a tick mark or a yes or no. So wherever you have a no, then you can go back to that and make sure that the FS properly captures that information. I think the other thing as well is sometimes I've seen um, people disclose too much information just because they've seen that in financial statements for other companies. And so it might not really be applicable or required to them. Not that it's bad, but that's just time that you can spend on other things. One of the key things about getting financial information out there is that it has to be timely, right? So if you spend all that time um, putting together information that's not really required, then it may not really be timely and useful for any users of the financial statements.
Yeah.
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 Uzoma, please, could you put your question in the chat as well? I see you have your hands up.
Okay. So one other thing that comes to mind is casting and cross-casting, right? So sometimes some of these things and even just spell checks, right? You find out in financial statement that if you add the numbers, right, you say maybe revenue less cost of sales, and the number is not adding up to gross profit, or gross profit less operating expense, it doesn't give you your operating profit, right? Just regular casting, whether vertically or horizontally, or even just spell checks, right? Or you see some like if I mention consistency in terms of disclosure, right? You are mentioning something somewhere, and when you go to the relevant note it's referencing, it's something else that is there, either in amount or in terms of narratives, right? Those are common things that you see that people make mistake in terms of financial statements. Don't forget that sometimes the kind of errors people see in your financial statements could also affect how people view the business itself, right? So you want to ensure that there's some level of different levels of review, right? Someone prepares it, there's someone else that does a review, there's someone else that does another additional level of review to as much as possible to ensure that the financial statement is error-free as much as possible. Otherwise, yeah, investors may have an impact in terms of investors or stakeholders' perspective of the business. Yeah. Um, so next one is, how do you handle discrepancies or conflict in financial data during the preparation process? Jerry,
How do you handle
discrepancies or conflict?
discrepancies or conflicts?
Mm.
Well, I think it depends on, I mean, if it typically where you have these discrepancies come up, it's more because your data or the information you're using has come from different sources, right? And so they aren't really speaking to each other. So you might get your trial balance, for instance, that has a specific amount in there, but the fixed assets movement schedule or your depreciation is not done on your accounting system. That's done offline, right? And someone calculates that on Excel. So it might just be that, you know, one calculation that was done wasn't posted into the system, right? So I think the key thing is just figuring out what the root cause of that discrepancy is and trying to resolve it. Um, and you do need to have one source of truth though. So just kind of riding on your previous point about going through reviews, right? There should be controls, right, in the company around who can post what and when. So if you have those kind of internal controls in place, and then you can then say, okay, well, what's in my TB or my trial balance has been reviewed by a more senior accountant or even all the way up to the CFO before it goes into my financial my general ledger. And so my TB is my source of truth. So what I then need to do is to look at the supporting schedule and figure out why that does not reconcile to my TB. Or it might just be, hey, when you look at your um, GL listing or your GL download, you can then identify that there's a specific journal that has not gone in. So if it's depreciation, you run your depreciation monthly, you expect that you have 12 entries. You look at it, you have 10. So you're clearly missing two. And that's why your GL does not agree with your offline schedule. So it's just figuring out what's the source of the discrepancy is, and then being able to align that. In terms of conflicts, I'm not quite sure what that's about, but for to hazard a guess, maybe it's more um, because in some cases you're preparing financial information, right? And the people who are going to be providing this information to you are not accountants, they're not finance people. And so they may not give it to you in a proper format. You might need to have a meeting or a call with them as early as possible to just kind of talk them through what you need and the format that you require it in. And, so that way, or maybe just prepare a template for them where it's easy for them to just put the information and then you can pull that from the template and that goes into your financial statements right away. So it doesn't really, you don't spend a lot of time, resolving conflicts or trying to address the discrepancies when you're putting your financial statements together.
All right. Thanks, Jerry. If any perspective on this?
Yeah, I think Jure touched on basically everything, but I think the area that I probably wanted to talk about was in terms of, so Jure had already mentioned how, you might have to get information from other departments that are not necessarily accountants, and they may not even realize how important the information they need to provide to you is. And so their attitude to that information is not their core work. So they, just leave it somewhere and do whatever they like, when the time comes, that happens. But I think that a very practical solution to that is what Jube mentioned. As the person in charge of the financial statements as a whole, I think it's really important to have templates of the different disclosure requirements, right? And how they fit into the financial statement. So if I had to give something to another department to populate for me, it's very important that I explain to them what numbers need to go in there. Because I've seen situations where the relevant department provides, numbers to the accountant, for example, and the financial statements are prepared, but those numbers are not exactly accurate, right? Either because whoever populated it doesn't really understand what numbers should go into a particular cell in a template. So that process of actually coaching and explaining to a team, this is actually what I need from you, will save a lot of trouble. The other thing I wanted to say is sometimes you need to have expectations of the kind of the numbers that you want to see. So you might not have exact numbers, but you know that you're expecting the information that is coming to be in a certain way. You're expecting numbers in this range. It then, something goes off in your head when you see that those numbers are not close or are not exactly in line with what you expect. It then prompts you to investigate further, even though you haven't actually seen a discrepancy in the sense that maybe the debits are not equal to the credits and there's a number that you're looking for. You might not even have seen that. But if it's not in line with your expectation, then you probably want to look a bit further. And I see this a lot when it comes to disclosures that don't really impact the primary statements, right? So it's not easy for you to see, oh, my assets side and the equities and liability is not balanced. That's easy for you to see because a number will throw out, right? But sometimes it's a disclosure that has no impact on the primary statements, right? But that disclosure is really important. And if you get that disclosure wrong, it might affect how your financial statement is read and how that is perceived by, whoever is using your financial statements. So those are things that I just wanted to, highlight in terms of conflicts and discrepancies.
All right. Thanks a lot, Ife. That coloring was quite insightful. Right. So I think, okay, so basically, what are the common issues with financial statement disclosures and how do you ensure that they meet regulatory requirements? I know we've kind of picked on this, but if you want to add any coloring or piece from yourself or Jiri, that would be nice.
Common issues, I think the biggest I've seen is just not being aware that something has changed, right? Um, so I had a client, for instance, send me a message recently about supplier finance disclosures. I didn't even know that was a new thing. Um, so it's just the key thing, and like I mentioned earlier, is just try to be as up to date as possible. Like I said, a lot of the big firms and mid-sized firms, they tend to have these publications that they release periodically, I think every 3 months or even in real time as those standards change. And so you can just go on their website and sign up so that when something changes, you get an email notification or something and you can go and read through that, right? If as long as you're up to date with those changes in the accounting standards and even from the legal standards as well, right? In Nigeria, a lot of your disclosures are also driven by the CAMA, and depending on what industry you're in, if you're in banking, for instance, I think there's a CBN Act or BOFIA, that Banking and Other Financial Institutions Act that determines what kind of disclosures you need to make. So it's just understanding, what's what is the gap that this company operates in, and what are the sources of those standards and requirements, and making sure they're up to date if anything changes in there. And then, yeah, the other thing which I touched on was just getting just checklists. So you get your general checklist from a consulting firm, and then you can also prepare your own checklist, right? Someone was asking the questions around internal controls, right? I think those are very helpful. And part of that review process for your financial statements is just making sure you have a proper checklist of what are the disclosures that are required, have they been made? And, like if I said, where you have options for the kind of disclosures that you need to make, have you gone with the right option? Or have you just gone with something that you saw another company do, even though it's not applicable to you? And I think the last thing is just starting early, right? A lot of the times we tend to underestimate how much work goes into preparing financial statements. And so if you start early, if you identify any new standards that are applicable to you, you can start collecting the information much earlier in the year or in the period. And if there are any issues or errors that need to be resolved, those that can be done timely, right, before the financial statements are done.
All right. Thanks, Jerry. Um, okay, so if and I think this for you, what are the common mistakes in the area of asset valuation and impairment testing, right, that you've seen?
Hmm. Okay. Common mistakes in the area of asset valuation and impairment testing.
That
So,
is such a very niche question.
yeah, and it's very wide because when you say assets, there are
Yeah.
different kinds of assets,
Mm-hmm.
right? There are different impairment rules for different kinds of assets. And I would give an example, a few examples. Your assets could be financial or non-financial. Non-financial assets, for example, you have a building, right? Financial assets, for example, maybe you have an investment in some debt instrument or some receivable, right? Both assets are required to be tested for impairment, but the impairment rules are a bit different to this, right? For a building, for example, you would have to do an impairment testing. If you notice any indicators of impairment, you do an impairment testing and then, determine what the value is. For a financial asset, for example, like a receivable or for an investment in a debt instrument, from day one, you're already, you know, it's not an impairment testing. You're already recognizing impairment losses as the case may be, right? So different rules for different kinds of asset. But in general, I think the most importantly, you need to know what standards apply to each of these assets. You need to understand how that asset should be valued, right? So for example, if I take the building, for example, the standard allows you to just measure it at cost. You depreciate using the historical cost, on and on till it's fully depreciated. But you can also have that building, and for a company, the accounting policy would be, yes, initially recognized at cost, but if there are any if there's any revaluation gains, meaning that so for example, in the market, that building is worth higher than what you initially bought it, you are allowed to increase the value of that asset. So it's the valuation of the asset is driven by the accounting standard, the options in the accounting standards, what accounting policy you have chosen for your company, and then the application of that to the valuation of that asset. One key thing or one error that I see is that a lot of times it's just a gap between a knowledge gap, right? Knowing when impairment is required, knowing when impairment is required on a particular asset, or what the standard has said, or how often a standard has said this asset should be, tested for impairment, right? That knowledge gap. For some assets, the standard says it should be an annual thing. For some standards, only when there's an indicator, maybe it's damaged or something, you go ahead to test for impairment. But having that knowledge of when you should impair or when you should test for impairment and how you should do it is I would say, a very common pitfall. And then also in terms of completeness, right, including a full listing of assets that are within that guidance, right, in order to apply that guidance to. I've also seen disparities in the list of assets that you apply the guidance to in a set of financial statements, and also errors in determining the recoverable amount. I don't know if I'm speaking above the heads of anybody, but what impairment is really trying to do is to make sure that in your books, you're not saying an asset is worth 10,000 when it's only worth 8,000, right? So you're not valuing an asset above what you can recover from that asset. That's what impairment is trying to achieve, right? And so sometimes there are errors in determining what that recoverable amount is, what you can actually recover from that asset. And what happens is that if you're wrong with your recoverable amount, when you get that, it might tell you that, oh, there's no impairment, and so you don't need to do anything to the value of that asset. And that would be wrong. It means that you're overstating an asset in your books that you should have actually impaired. So those are the common mistakes that I have seen with impairment testing. But I would say the biggest would be that knowledge gap on when an asset should actually be tested, depending on the type of asset it is.
All right. Thanks for that. I think that was quite insightful. Jerry, any coloring to that?
Um, Asset valuation and impairment test. I think if I did touch on a key thing, it's typically annual. right? Unless there's an indicator of impairment. Now, it also depends, it depends on what type of asset you're looking at, right? The way you'd impair or value your financial assets, like your receivables or loans receivables, will be different from PPE or an investment in a subsidiary or goodwill. And all of this have their own specific accounting standards that give you kind of a step by step, or not step by step, but an overview of what is required. The key thing is just what are the cash flows that are expected? And do you expect those cash flows to be sustainable over the expected life of the asset or not? If it's going to be lower than your current carrying value, then you need to impair it. I think is probably the most straightforward way to look at it. Um, if you're looking at financial instruments, for instance, and you're looking at like your expected credit losses, I think the IFRS allows you to do like a complex model or a simplified approach. Again, it's I don't want to get in too much into the technicalities of this here, but I think the most straightforward way to think about it is what information is available for you as a financial accountant, and then how best are you able to forecast the cash flow that that asset can generate, right? If there's any indicator of impairment, which is just to say that the cash flows will be lower than your current value, then you need to impair it. I think more often than not, the biggest mistake I've seen is just people tend to overestimate the actual cash flows that the asset can generate.
All right. Thanks, Jerry. So I'm going to now pause where we get participants to just ask questions so that we can generally just respond to them. For those, if you want to actually want us to unmute you, just raise your hand, right? We're more than happy to listen to questions and people just expressing themselves beyond just chat. Okay, Uzoma. Yeah. Hi, Uzoma. You can unmute yourself.
Okay. Hello, can I be heard? Good afternoon.
Yeah, good afternoon.
Okay. Can I be heard?
Yeah, sure.
Okay. Okay. I just want to appreciate Accounting Yard for this insightful webinar. I've actually learned a lot joining this just being on the call already. I've learned a lot. But there's I have actually had some challenges when preparing financial statements because I currently work with government. So at the point of preparing financial statements, there are some transactions that are beyond beyond my knowledge. And when those things come upon us like that, we tend not to know when to post those transactions. For instance, we have instances where the state government might do a free donation of vehicles to the institute. And we don't actually know when to post it because they are not giving us, we didn't buy it, there's no documentary evidence stating how the assets were bought, but just a donation to the school. The accounting entries to post such transaction, we don't know how to also post them. And we also find ourselves in circumstances where at the point of preparing our financials, there's no fixed asset schedule. There's no schedule anywhere. And in the statement of financial position, you also recognize assets. So as an accountant, you tend not to know what to do at that point in time. So I just want any of the panelists to help me out. Thank you.
Okay. Jerry, fine. Any thoughts on Uzoma's question?
So, I mean, that's a difficult one. Uzoma, thanks for your question, but that's a difficult one because preparing financial statements are driven by data, and if you're in a situation where even that data is not easy to come by, I do understand, when you say, I mean, what happens in government entities, and sometimes you just don't know where things are coming from. So that's a difficult position to be in, right? What I would say is, sorry, just a question. are you the head of the unit or do you have somebody above you? Uzoma.
Yeah, I'm trying to unmute him.
Okay.
Yeah.
Okay.
Uzoma.
Okay. No, I'm not the head of the unit, but I'm the one in charge of operation of the financials.
Okay. Okay. So, well, for me, right, for every debit, there's a credit, right? It's supposed to be, equal and opposite. So if I've been told, or if I get information that, oh, we've donated a sum of money to whatever, I need to be seeing that outflow from cash, right? I need to have, once I have an idea of the transaction, I have an idea of what I expect it to impact, right? And sometimes you create records from incomplete, information. So, and that's the technique you need to have. When there's a transaction, you have an idea of what lines you expect it to impact, right? And then you can have that conversation with your supervisor, knowing where exactly you should take that to. But I mean, the double entry principle remains the same, right? If it has gone out from cash, it needs to be somewhere. Is it going into our profit or loss as an expense? For what we have donated? Did we buy assets? Does it need to be going to PPE? We just need to be able to think about the transaction and then determine what lines you expect it to impact, and then have that conversation with your supervisor so that you're clear on what postings you should do. But it's a difficult situation if you don't have, the data to support what you're doing.
Yeah, and I think, you know, you touched on the key thing there. Just having incomplete records is a big challenge. And I've seen there are quite a few questions that have come through about preparing financial statements for companies that don't have proper records or they've not prepared their accounts historically. I think it's the same with government as well. One thing with government that maybe might make things in quotes easier compared to a private company is that government accounting, public accounting is typically cash based. And so to Ifane's point, if there's a donation or there's an expenditure, that money would have gone out of some bank account. And so that typically, in my experience, is our starting point when we're trying to prepare financial statements for government agencies and NGOs that also do cash-based accounting. So we start with the bank statement and kind of work back from that. So you're looking at your bank statement, you're looking at, you're having those conversations with your supervisors, and if you have access to those minutes of meetings, where they've discussed making these donations, that might help you steer you to like what bank and what amount am I looking out for in here. But I think the bank statement is probably a best place to start from. And then going from there, depending on what other kind of accounting records you have, maybe you have vouchers for payments or, you know, bills and things like that that have to be signed by people, and then you have the copy of that somewhere. And that's typically how you build up and go from an incomplete set of records to something that you can use to prepare financial statements. But maybe that's depending on what the demand is like. Maybe that's a separate session that accounting yard can go into, because it is tricky, and it's not something that I think we'll be able to cover in detail on this call itself.
All right. All right. So let's hear from Okon Blessing. Hi, Okon. Hi, Blessing.
Hi, good afternoon. I think the question I want to ask has already been answered. It's still concerning this incomplete records, not having enough information.
Oh, okay.
So I guess I've gotten some insight on that. Thank you.
All right. Thanks a lot. So let's go to Quadri. Hi, Quadri.
Hi, good afternoon, everyone.
Yeah, good afternoon.
Please confirm you can hear me.
Sure, we can hear you.
Oh, okay. So first of all, kudos to Accounting Yard for their persistent and insightful webinar. Because I've attended several webinars, and in the process, I usually learned a lot. Okay, so my question is concerning the detection of error in the process of asset valuation and impairment testing. So I would like to ask that what are the basis for the valuation, and did you usually call a valuer during the valuation, and how do they usually determine the value? I understand the fact that the standard requires provided two options for the subsequent measurement. So, to my best knowledge, I felt revaluation is usually being done probably during merger and acquisition, or probably we're on the floor of stock exchange. So, I would like to know that what was the basis for the revaluation? Did you usually call a valuer during evaluation, and how do you determine the fair value? That's my question. Thank you very much.
All right, thanks.
Okay, so I will start by saying that there are different standards that speak to different kinds of assets and options for valuing those assets, right? So, for example, I talked about a building, PPE, right? A PPE that is, a building that is PPE. A building could also be an investment property. For example, if you're renting it out, or you're keeping it for capital appreciation, or both. But there are different accounting standards that speak to building as PPE and then building as investment property. These are the accounting standards will tell you the options that you have to value each of these items, whether it's a PPE or investment property. And the accounting choices are not exactly the same. So for building and PPE, and I'm saying this to give you context, to give you an example. For building as PPE, the standard says you can use a cost model or revaluation model. In both instances, you still need to depreciate the building. But that building as an investment property, the standard says you could use the cost model or use the fair value model. And if you're using the fair value model, you don't have to depreciate, because what that means is that you would determine what the fair value of that building is every year and take any loss or gain as the case may be to your profit or loss. So the point I'm trying to make is that it is not a one size fits all. Each of these assets are governed by different standards, right, that tell you how to value these standards. Sorry, that tells you how to value these assets. And these assets, these standards could have options in there. So it also depends on the option that has been chosen by a particular entity in terms of valuing that asset. Now, there are some assets that you as a business, you will not have the capability to value that asset. So if as a business, I own a building that I use for rent, and I've decided that I want to use the fair value model, I don't have the capability to value that building. I might engage the services of some professional estate valuer or something. I will engage their services and they will provide me with the value of that building. And then I can use that value in my books. So for some of the assets that you have, you may not have the capability to value that asset. You might need the services of a professional to value that asset. For some assets that you have, you will be able to value the asset. So for example, if I have investment in the shares of a company and it's a publicly listed company, I can see the value of those shares, and the valuation in my books will be the number of shares that I have multiplied by whatever the market says is the value of those shares, right? And I value that asset in my books. So it varies. It varies from asset to asset. And that's why I said that the key gap to close is that knowledge gap on what is applicable to any asset per time. I hope that answers your question.
Yeah. So I think you've done a thorough response to that. So pick the next question, Mustafa. Unfortunately, I don't think we'll be able to answer a lot of, I think we'll just stop at Mustafa, because of time. Mustafa. Hi, Mustafa.
Yeah, but for the others, please put your questions in the
Chat.
chat as well. So
Yeah, sure. Hi, Mustafa.
Hi, good afternoon, everyone. Can you hear me, please?
Yes, sure, we can, Mustafa.
Thank you, the moderator. I think you are doing a wonderful job. And since I've joined for almost 2 hours now, I've learned a lot, things that I thought I knew in the past. But thank you for this opportunity. And here is my question. There's a goodwill which arises on a business acquisition for like 3 years. It has been in the book for 3 years, and there has not really been any movement in the ledger for like 4 years, 3, 4 years. So now the auditors are now insisting that we should that we should test the intangible asset for impairment. So despite though the company has been in loss for like 2, 3 years, but now they are back in profitable position. So my question now is that is it a must that we test it for impairment? And if we have to do that, which approach you think is the best for us to adopt? Thank you, sir. That's my question.
Okay.
All right. So for goodwill, right, again, we need to know what the standard says about impairment for goodwill. For goodwill, you're required to test for impairment annually, right? And in addition to testing annually, anytime there's any evidence of impairment, even if test annually for impairment at the same time every year for impairment. And then even if it has not gotten to that time where you test for impairment, if there's an objective evidence that there might be some impairment, go ahead to test goodwill for impairment. And again, I go back to the standard. There are rules for testing for impairment. For something like goodwill, goodwill cannot be tested for impairment on a standalone. It has to be tested for impairment in a CGU, like it could be a business or a division. The goodwill has to be tested as part of that division, as the case may be. Now, you said, I want to assume from what you said that the goodwill is part of a business that was acquired and that this business had been making losses. That should have triggered impairment from years before, triggered the test for impairment from years before, right? But anyway, we are at this point now, and you have to test for impairment. Again, back to knowing what the standards is about testing impairment. You need to find out how much value you will get from that business if that business keeps on running, right? And this is where the cash flows that Jire talked about earlier comes in. And you're trying to determine what's the value I would get from this business if it keeps on running. And that's what we call the value in use. You also want to check, if I have to sell this business today, how much do I get? And that's what we call the fair value of that business, right? Less any cost you will incur to dispose of that business, right? Those amounts that you get, the higher of the both of them is your recoverable amount. And if that amount that you get is lower than the carrying amount of the goodwill that you have in your books, then there's an impairment, which means that you need to write down the value of that goodwill. So that exercise needs to be done. In determining the value in use, this is where you need to project the cash flow. So how much cash is this business going over time? You need to project the cash flows over the period, the cash outflows and inflows over the period. All of that. It's a complex exercise, but you need to do all of that to be sure that the carrying amount of that goodwill in your books is not overstated. And it's a worry if that business has been generating losses over some years. Then it's very important for you to actually go through that exercise, test for impairment, and check whether you can actually recover the amounts that you have in your books. So I hope that answers your questions.
All right. I think you've done justice to that. But I'm sure if there are any questions, Mustafa most likely send a message to a chat box. Um, so now we moved on to the next section where we talk about future outlook and best practice. And so, Jerry, this question is for you. Looking ahead, what changes do you foresee in financial statement preparation and reporting practices?
What changes do I? Well, I think the biggest would probably be driven by what IFRS 18 is asking, and maybe if I would touch on that in a bit more detail. But my initial glance looking at it is it's going to change basically the structure of your income statement, I believe, and you will be matching your expenses based on more based on their nature, right? The way you prepare your cash flow, where you have your investing, operating, and financing activities, like that's how your income statement will be prepared, and that might also impact other primary financial statements. So I think that's going to be the biggest change. Any other change will also, of course, be driven by any new accounting standards and any updates to existing standards. IFRS 18 is replacing IS 1, for instance. We've had in the last 5 to 10 years, changes to financial instrument standards. I think we talked about the ESG standards. So you have your IFRS S1, IFRS S2 that may or may not be applicable to your business. So financial reporting tries to catch up with what's happening in the world itself, right? And right now, the world is big on sustainability, the world is big on climate change, and a lot of investors and shareholders are concerned about that. So that's something that, depending on what industry you operate in, might be applicable to you. If you work in a financial institution, money laundering, is something that's top of mind for regulators and investors as well. And so there might be a requirement for more robust disclosures in the financial statements about that as well. Um, and so it's really just driven by what's happening in the world. The key thing, I think we touched on this earlier, is just try as much as possible to stay up to date with what's happening with your business, like the company as a whole. Don't think of yourself as an accountant and you're like, oh, all I need to do is just make sure the accounts balance. No, you actually need to understand the business. You actually need to understand what legal frameworks they operate in, if there are any changes to that. And you also need to understand the accounting requirements that might be published by the IFRS or whatever national accounting board operates. I think another thing is, and this also impacts auditors on the call. There's more of a look to, I think, with AI and the advances with AI, and everyone's part of I think we'll call this an instant culture. There's a shift to go away from historical financial statements, and you're looking more about at things that happen in real time. So for publicly listed companies, the time frame for reporting is going shorter and shorter. Typically, it would be 3 months before now. A lot more companies are reporting within the first week of closing their account. And I guess within the next decade, it might be you actually just have real-time information, and even the auditors are reviewing that information in real time. And so the shareholders and stakeholders and investors and the general public have access to real-time information on the financial position and performance of the company. So the key thing for you is like sessions like this, just try to stay as up to date as possible, I think is the key thing, because there's always going to be changes that will be driven by what's happening in the world.
All right. Thanks, Jerry. Ifeanyi, do you want to add any piece of coloring to that?
Not exactly. I think Jerry has covered the three areas that I would have talked about, which is, tech. I mean, AI, that's the new wave, right? And he has also talked about ESG. There's increased focus on sustainability reporting. And if you're an organization that will want, investors, especially foreign investors, ESG is something that is making waves, and they'll really be interested in knowing, how sustainable your business is, and your impact on the environment, basically. So that's also a big one. And then also, Julie already talked about regulatory changes, IFRS 18 that's coming, that's going to basically change the presentation and disclosure in your financial statements or your primary statements, and then some of the notes as well. If you new things are being introduced, and the key to all of that is just staying abreast of what is happening, right, globally, not just in Nigeria, but what's happening in the financial reporting space globally, right? Just staying abreast of all of that and seeing how you can take all of that information that you have and apply that to, for example, where you work and all of that. But those are the three key areas that I would have also talked about: tech, ESG, and regulatory changes.
All right, that's fine. I think this is the last but not the least question. Sorry. Yeah, what are the best practices you would recommend for ensuring a robust and reliable financial statement process? Jury, are you fine? Anyone?
So I would say be very skilled in, the applicable accounting framework. If you're in Nigeria, then it will be IFRS. Be very skilled in that. Also ensure that in terms of your data as well, ensure that, you have good data and you're establishing a trail as well, so that just in case there are any inconsistencies, you can actually follow that trail and, be able to sort out any errors. You may also want to consider, for a lot of medium-sized businesses, I'm imagining there's probably a mix between, some automated parts and some parts that are manual. You may want to consider whether, just to eliminate as much as possible human errors because of manual interventions, you might want to automate a lot of all the mechanical parts of preparing the financial statements, right? And so that your accounting team or financial reporting team or whatever it's called can focus on, the judgmental areas, when it comes to financial reporting. And then also you can't underestimate, regular monitoring and review. You can't leave things to the end of the year before you start. Monitoring and review should be ongoing as often as possible so that you can spot errors and correct errors, as they go, right? So, and then also what I would just say is also making sure that your financial statements are very clear, right? It's not about putting so much information into your financial statement. It's about putting information that is relevant and can make a difference to decisions that users make based on those financial statements. So you want to make sure that you're having you put in just the material information, and it's also clear and understandable as well in the financial statements. I'll allow Jerry to add any other thing.
All right, Jerry.
Yeah, I think like just listening to you, a lot of the things that you said are outputs of having proper controls in place. Now, depending on the size of your company, you might have a full-fledged internal control department and proper, robust internal control mechanisms. Or if it's just you and your unit, then you need to then start thinking about, well, what's the information that I need? If I mentioned monitoring and review, right? What's the information that I need? When do I need this information? And how do I make sure that it's complete and accurate, right? So it's engaging with um, the people who'd generate that information for you and making sure that that information is put together timely. So if you are looking at depreciation, for instance, you want your fixed asset accountant to run depreciation or calculate depreciation, right? And then that will be reviewed by someone else. That's your control. And why do you want that? Because you want to report, you want to make sure that the amount that you calculate, that you put in your financial statement as depreciation is correct, right? And so it's more about just think about the control, think about what information is going to your financial statement and how can you get that early enough, reviewed timely so that it's complete and accurate. I think that's if you have that in place and you're able to manage your stakeholders, your other staff, that really in line with all of the other stuff we've discussed, checklists, staying up to date and things like that. Those really are the best practices to making sure that you have a proper process in place.
All right. Thanks, Jerry. Thanks a lot for that. So they just want to just reemphasize that there's a training to start by 5th of October. So if you're interested in actually learning how to pay financial statement from beginning to the end, do feel free to join the training. We'll share on various social media platforms and also on the webinar group so that you can get more information as regards that. But before we call the day a close, we'll basically just go through. Jerry, you can just help with going through messages on the chat box, and we can just basically address them. And before we now call for a close for today.
Okay. So I'm just scrolling through to see. I think as we're talking, I did try to respond to a few of those. Okay, so there was a question on the practical session, which you said that will happen in October. We've talked about ESG already. Okay, so there's a question here on whether you need to follow IFRS for management accounts. No, you don't. Your management accounts are what you make of it. There's no specific standard for preparing management accounts. If you're preparing financial statements for external users, though, yes, there are specific standards, IFRS or IFRS for SMEs or government accounting standards, depending on what industry you're in, that you need to follow for that.
Yeah.
I think I saw that someone had their hand
Yeah.
raised earlier as
I
well.
mean, just add to that, right? So most times what people try to do for money account is make it as reasonably compliant with IFRS as much as possible, such that when you need to prepare your financial statement, the number of adjustments you need to make it fully compliant will be very minimal, right? So nobody says it must be fully compliant IFRS, but as much as possible, people ensure that the money account is reasonably compliant, right? Things that may be missing out are in terms of it may not get all the level of disclosures and all. It may just have reasonable disclosures in terms of notes that ensure that management and whoever people you need to share the money accounts with are as informed as reasonably possible, right? Yeah, but that what I'll just context I'll just add to that.
Yep, great. There are a few questions on joining the AY group, so I think that's something you'll probably share that information
Yeah,
on
so
that and the link
yeah,
to the webinar as well.
Yeah, so I know there's a group for the webinar. So if you're on the group on the webinar, I'm sure information relating to accounting yard. So we'll send a message. You can basically add the accounting yard official number, and that way we'll also just send a message to the accounting yard official number. And typically that's the number that's been posting a lot of things on the social media on the webinar group, right? So you can access other things. Yeah. Yeah.
And will you be using any software? Will you be taking people through any specific software for FS preparation?
So the FS preparation training is going to be done on Excel, right? Because really that's where you can really learn a lot related to FS preparation. I know there are tools used in preparation of financial statements, but in terms from a cost perspective, using Excel will be more like the most efficient way to actually prepare it at the very least at the moment, right? Over time, you can now get to learn use of some tools that will help you in terms of FS preparation.
Okay. I think those are all the questions.
All right. I guess we are almost about reaching the hour. But if you have any questions and you think that maybe you want to speak, you can just raise your hands and we'll mute you and we can answer those questions directly. But in the absence of no question, we can just call the webinar a close. And very much want to say very much thank you. Okay, so I think Abubakar wants to say something. Let's hear what Abubakar has to say. Hi,
Yeah, good afternoon, sir.
Yeah, good afternoon, bro.
Yeah, thank you so much for the webinar. We really appreciate. And we thank the tutors as well. Please, my question is during the earlier discussion, so one of the tutors made mention that FS can be prepared using MS Word. So I don't know if I get that wrong or if it is possible. I would like to know how possible that is. I don't know if you get my question.
Yeah, I got your question. Right. So I know that what typically happens for most so yes, it can be done on Word, right? But trust me, it comes with a lot of practice and knowledge in terms of use. I don't know, Jerry, was that you or you find I mentioned that?
Yeah, I think that was me. Yeah, and I personally don't like using Microsoft Word or reviewing FS prepared with Microsoft Word because of some of the challenges around cross-casting, which you talked on, and internal consistency, which Ifeanyi talked on. With Excel, you can link your numbers right from your FS, the face of the FS to the notes. With your accounting software, that's updated automatically. With Word, typically, when you change something in the notes, you then need to read through the whole set of financial statements to keep track of what has changed. Again, so I don't like to use it, but in my experience, I have seen a lot of people who actually prefer to use Microsoft Word. So it's more just what works for you, right? And what's the most efficient way to getting it done.
Yeah. I know there's some people that are actually very quite good with using Word, and if you see
Yeah.
them use Word to prepare the FS, but I think from my own experience, they don't start with Word. Right. So they'd have done majority of the work on maybe Excel. When they've now gotten to a point in which they feel the numbers are finalized, they do the formatting and in terms of everything on Word. How they move from Excel to Word, I'm not very certain, but they perfected the act of formatting on Word that if you see it come out, you'll be shocked and amazed by what they could do
Yeah.
with Word. Right. So yeah, hello.
So good afternoon, sir.
Yeah, good afternoon.
Thank you for this opportunity. I really appreciate it. So straight to my question. So I want to know in the financial position, the PP at the end of the year, are we going to recognize it as cost or at net book value? That's my first question. My second question is, what's the difference between revenue reserve and retained earning? Thank you, sir.
Okay. Hi, Jerry, do you want to answer that?
I think I heard the first part of the question asking if at the end of the year, you're recording your PP at cost or net book value. Was that the question?
Yeah, that was the first question.
Yeah, so at the end of the year, your financial statements are presenting your assets at the net book value, which is basically your costs less any accumulated depreciation to date. Like that's what your IFRS 16 requires. So your GL would have the costs in some account, and you have a separate account for recording all of the depreciation um, from the date of capitalization to the date that your financial statements have been prepared.
Okay. So the next one was any difference between revenue reserve and retained earnings.
I'm not sure what a revenue reserve is, but your retained earnings is basically, or retained loss is just an accumulation of the net profit or loss of the company since from inception to date. So it's basically a reserve. It's a kind of reserve as well,
Mhm.
that accumulates all, just showing the performance and how profitable the company has been since it started operations to date. And maybe the revenue reserve is just another name for that. I'm not sure I've come across that term before.
Yeah. I think I've come across revenue reserve, but I think it's a very old name, right? But yeah, we can always just double check and come back to it. But I know it's very old name. Nobody uses it anymore, right?
Yeah.
And what you may just see that people may just interchange revenue reserve with retained earnings. But the most appropriate name in terms of where people talk about now is the retained earnings, and that's what Jerry has basically explained.
Yeah, and I just wanted to add that, I mean, when it comes to reserves, um, generally you can have different reserves that you use for different classes, right, within equity. So different reserve buckets that you use for different purposes. I think the key thing, even what we call retained earnings, some entities call it, so some entity might call it a profit and loss reserve. Some
Yeah.
they might have different names for what we know as retained earnings. But I think the key thing is for each reserve that you have in your financial statements, the standards require you to explain what that reserve is. What amount, what's the nature of that reserve? What do you hold it for? So if you call a reserve a revenue reserve, then it's your responsibility to write in your financial statements that you have the revenue reserve, and these are the kinds of things that the balance is made up of this kind of thing. So you should explain what that reserve is. So less emphasis on the name that is given to a reserve, but more emphasis on explaining to your users what that reserve is used for and what you accumulate in there.
Mhm. All right, thanks, it's fine. We almost thought we lost you, but thanks for bringing that up. Ayomide, you have a question?
Yeah, yeah. Good afternoon, sir.
Yeah, good afternoon, Ayomide.
Yes, sir. My question is that, like, as a student now, a student, say 200 level student, and also restricted to some um, some applications. Also, maybe I mean application like with restrictions to system. So how can I prepare this financial statement on my using my Android phone, like for the meantime? Hello,
Okay.
sir.
Yeah, I heard you, Ayomide. So,
Yeah.
personally, right, I've not seen someone use a phone to prepare financial statements. Jiri, and if you can correct me in case you've seen, maybe technology may have gone beyond my my own way I see things, right? But typically, the applications that we are most likely like ones used on desktops or laptops, right, using preparation of financial statements. I think that the process will be quite may not be seamless. On a tab, potentially possible, but phone, I think that process may be quite very may not be as smooth sailing as you would expect it to be. But Jury and if I can correct me in case they have experience using phones to prepare financial statements.
No, no, I haven't come across that. But I mean, what I can recommend, if you do have a laptop or at your university library, they might have, Microsoft Excel or maybe some online resources might be available. But I think just because you're doing it on the phone, the computing power and then the size of the screen is very limiting, right? So I wouldn't recommend that from a user experience perspective. But
Oh,
reach out. I think most libraries would have computers that you can probably spend some time using to practice. Would be your best bet.
all right. Thanks, Jerry. The last but not the least, Dr. Olauti. Hi, hello, Dr. Olauti.
Uh, Hello, sir.
Yeah, hello.
Okay. Are you hearing me?
Yeah, sure we can. Sure we can.
Okay. Thank you very much. Firstly, I just want to appreciate the pioneer of this country here. I want to say that this is my first time of joining the platform, and in fact, I am blessed with all what we have gone through. This is very, very critical, and I want us to keep it up and at least to make some of us to be abreast of what, like, FIRS is free, standard is free. I just heard it today, and I want to believe that more will come in the near future. Oh, this is nice. The only thing I just want to say is most of the something that we have raised. I don't know if we can share it with us on like a slide on the platform, and also the recording to some of us so that we can have something in our buffer. And that is one. Number two, concerning the Excel preparation of the AFS, I think it is very, very critical, and we need that one to come up very, very soon so that we will be coming up with a token, at least something that will not open our pockets down. You know what is happening in Nigeria now, but I want to believe that many of us will join the campaign because when I look down the participants, I think we have more than 200 people on this platform, and I think it's very, very, very good. So I just want you to keep it up, and we will continue to do it. Thank you, the organizer.
All right, thank you, Dr. Olauti. So we have a YouTube channel. So typically recordings of webinars like this are uploaded and posted on the YouTube channel. So even past webinars that we held can actually be watched on the YouTube channel. Then as regards the training, our training are very pocket friendly. So for example, the financial statement preparation training coming up in 5th of October goes for just 15,000 naira, and you can join virtually. And it's roughly for almost 8 weeks, right? For physical participants, right, it costs roughly 50,000, and you can come to our physical venue. The 15,000 I'm mentioning is for those who join the webinar, right, for virtual. Typically, it goes for 20,000, but because you're a participant of the webinar, you can enjoy the discounted price of 15,000, and you can do that before the 19th of this month to enjoy that benefit, right? And that'll be posted on the webinar group, so all participants can basically enjoy this opportunity, right? So yeah. And in terms of any other document that I mentioned, we'll definitely put them together and share them also on the groups. So our last but not the least, Hilary. Hi, Hilary.
Hi, can you hear me?
Yeah, sure, we can hear you, Hilary.
All right, sir. Thank you very much for the insight so far. I think I've been following the conversation for some time now, and there are some issues that were raised. One on the issue of preparation of management accounts, and then a discussant did mention that the preparation of management accounts does not necessarily need to comply with IFRS. I don't have much of argument, but preparation of financial statement ought to comply. But on the chat box, someone was trying to link preparation of financial statement to auditors. So I'm kind of confused. Is it the responsibility of the auditors to prepare financial statements or the management team? That's the first question. Then the second question is on the estimate and fair values. In determining estimate and fair values, I heard one of the discussants did mention that it's advisable to use the services of a professional valuer, especially as it relates to PPE. We had an issue, a practical example where a service of a valuer was contracted, and in our opinion, the assets were overvalued, probably to inflate their professional fees. When you have such instances, and won't you think it will be better you use market value? Will it be wrong if we decide to use market value as the fair value of the asset?
Oh, okay. All right. So if I heard you well, so there are three questions you raised. One was in terms of preparation of manual account and financial statements in compliance with IFRS. Second one was who should prepare your financial statements? Should it be auditor or the accountant of the company? Then the third one is around valuation of assets, right? Where
Yes.
there's some level of like you are doubting the competence of the valuer in terms of the outcome he has provided. Now, so in terms of manual accounts and financial statements, so typically what we respond in terms of manual accounts are manual accounts can be prepared in line with IFRS, right? But don't forget that IFRS requires some level of disclosures and some level of information to be prepared. So most times your manual account may not be fully compliant in terms of from that perspective, right? But can be reasonably compliant in which that because most times don't forget that the underlying data itself may not really change when preparing your financial statement, right? So you want to ensure that is reasonably compliant so that when it gets to the preparation of financial statements, the necessary adjustment that need to be passed will be very minimal. Otherwise, if it's far-fetched, right, then you will require a lot of adjustment to make it compliant with IFRS when you're preparing your financial statements. Does that answer your question from that perspective? Then the next one you mentioned was it's actually the responsibility of the accountant of the company to prepare financial statements, while the auditor reviews, right, and confirms that what he has prepared is actually correct, right? But we find more often than not, all right, that you find the auditors preparing and reviewing it. And why is that the case? It's the case because most times what you find out is that the accountants of companies cannot either prepare or when they prepare, there's a lot of work that needs to be done to get it to be in the right format and to be compliant, right? And it's one of the reasons why we're actually creating this webinar and also creating a training on financial statement preparation because we identified as a gap in terms of the knowledge required in the preparation of financial statements, right? So the actual practice, the accountant, right, of the business should actually be the one preparing financial statements, right, and not the auditor. The auditor is meant to review and ensure that what you've done is actually as in well done. Otherwise, the auditor will have what we call a self-review threat, right? Now, the last one, from a perspective of the way I see it, when you saw there was an issue in terms of the evaluation that the specialists had brought up, it means that to a large extent, I would think about what was their approach in terms of determining who should actually do that valuation. Because definitely, if you are calling the person an expert, it's either the person is not competent. Because to be honest, even look at our professional, for example, right? You have people who are chartered, but when you see the quality of the work they've done, you'll be doubting the qualification that are you sure this person is a chartered accountant, right? I don't think that is limited to only accounting. We find our problem across multiple professions. So the situation you found yourself in terms of the valuer not doing a thorough work may be a case of the person is not competent to actually carry out that work. So I'll reassess, have I gone identifying the right valuer to actually carry out this? And clearly, if someone has done evaluation for me and I can pinpoint errors in what he has done, then I think the person should go back and review the quality of the outcome of that work he has done. Yeah. If there's market survey to that, we can really provide an answer if that will be an alternative measure, right? Where you've carried out like a market assessment of the value of asset, if that can replace that of a professional. But I think the professional valuation will carry higher preference in terms of where we see the valuation of asset to go compared to you just carrying out your market survey.
And just on that as well, I think typically with valuing assets, you don't always need to use a professional depending on whether you actually have market information. Of course, it has to be an active, liquid market, right? Not one where there's a sale every 5 years. And the challenge with that is also having to find an asset, that's similar to yours. And that's why a lot of companies just default to getting a professional valuer. From an audit perspective, and this I think would also be applicable to you as an accountant, one thing that we need to look out for is we assess the competence of the valuer, right? Which Dele has touched on, just checking that one, they're actually registered with whatever valuation body is applicable in that jurisdiction. The other thing is we also review the terms of the contract. So I think there was something you mentioned that was kind of like a red flag to me, where you said they had overvalued the assets perhaps to increase their own professional fees. Now, your professional fees would typically normally not be linked to the value of the assets, right? So if I did see that in an engagement contract between a company and a valuer, that valuation is not something that I would rely on for my audit work, right? And so because you need to be independent of the client that you're providing that service to. So it's more just understanding whether they are independent, they are competent, and then they're using the right methodology, right? That's required for that valuation. I think if those boxes are ticked, then you should be able to rely on the valuation. Now, if you think that the asset has been overvalued, right, that's a conversation that you should also have with I don't know if you are the one reviewing it directly or if you're talking with the supervisor or you're dealing with the valuer directly, but I think those concerns are things that you should discuss with them and with your auditors as well, because there could quite possibly be an overvaluation risk there that needs to be addressed.
All right. Thanks, Jerry, for that. So I think basically, we answered everyone's question, and I think we can call this an end. We are almost 12 minutes past our time. So we thank everybody for joining this webinar, and I hope the webinar has been very impactful as much as it was me engaging and also being able to coordinate this one. And I want to say a lot of thank you, or I'll say like a lot of appreciation to Jiri and Ifeanyi being able to make it up for this webinar. And as they've been able to impact the lives of a lot of people on this webinar, and a lot of people will also watch it on YouTube. So yeah,